Oh, it's Angola. Oh, sorry, by the way, it's Angola.
Mr. Patsy, I might not be in the lecture for long because I'm not feeling well. Maybe I got typhoid. So I don't know what time the driver is coming to pick me to go to the hospital. So I might leave in between the lecture or any other time. I don't know.
Oh, this is sad news, but the beauty of it all is life belongs to God. So get well soon. May the good Lord be with you. Don't even be afraid of anything. You know, the body turns shaken. Just it's a normal thing. Even a vehicle passes through potholes, but in final analysis, the drive of the vehicle ensures that it sails through, and the drive of our life is the God Himself. So we accept your apologies and we wish you well.
Okay, thank you.
Welcome. Now, today's discussion is capital gains tax. Right on it. This is our last discussion, and I had to come to town because if I had failed to come to town, CGT, capital gains tax. This is our last discussion item, and make sure you by end of day tomorrow you have a copy or a link to our last week's video, which was on tax administration. So you have to have these two. So what is capital gains tax? You know, it's a different branch of tax altogether. So this is a tax. This is a tax which is levied, meaning charged, which is levied on gains from disposal of immovable property, or immovable property and marketable securities. That's capital gains tax. That's capital gains tax. It's a tax which is levied on gains from disposal of immovable property or marketable securities. Actually, it's from 1 August 1981. The definition concludes by saying from 1 August 1981. Why 1981? It's because this is when this particular Capital Gains Tax Act was promulgated. Were you born yet, Tendai, in 1 August 1981?
No.
No wonder why we always say panotaura wakuru ananyararai.
I was born 11 years later.
Oh, terrible stuff. No, as for me, I was born on 11th of May 1968. So I had seen it all. I know you guys would say, please give us a break, which is pretty cool. But the bottom line is, I'm an elder. Okay, Cynthia, how are you? Cynthia, urungopinda ubuda. Chichikuitika. Don't worry. Ukona zvichinetsa lecture ichirekodwa usazvinyanye kuzviisa muhana stereo. Right? Continuing. Immovable property and marketable securities. Now, iwe Ernest, uri mutown here?
Ndinogara Mount Pleasant, saka I'm in town.
Kana ndandati pamwe unondarika nemutown because ndinogara kumaubra ndandati umbodarika one kuoffice after the lecture shan ndiri panapa. Remember ndichazoita mama lectures anotopera kuma 11:30.
No, I can come and pick you up.
Pardon?
I can come and pick you up. After the lecture.
But I'm also driving.
All right.
Yes. But it is still fine. If you tell me your workplace, I will visit you because in the next shop kangu papendenisa, so I can still pass by.
All right.
Yes. Immovable property and marketable securities are collectively known as specified assets. Saka chinoitika pa capital gains unogona kunzwa question ichiti kana statement ichiti gain which is levied on specified assets. Saka rega ufunga kuti zvimwe zvinhu zvakunzi specified assets. Ma-specified assets anongori immovable property and marketable securities. Ma-specified assets. Now, rates of capital gains tax. Rates of CGT, capital gains tax, capital gains CGT. On this one, I need you to pay attention. You know, we assume that everything here is in Zim dollars. It's in Zim dollars, meaning ZWL, whatever that means. So, one, and say specified assets acquired after 1 February 2009 and disposed prior to 22 February and disposed prior to 22 February 2019 and disposed. We are saying specified assets acquired. I mean, you know, for me to just simplify it, let me say specified assets acquired before. Otherwise, I'll confuse you. Before 22 February 2019. If you sell an asset which was acquired before 22 February 2019, then capital gains tax equals 5% of disposal proceeds, 5% of gross capital amount. For present purposes, let us say disposal proceeds. Disposal proceeds. Please pay attention. We are doing it step by step. Two, you now know what we mean by specified assets. Specified assets simply means assets, immovable property, and marketable securities. So another is specified assets, acquired after 22 February 2019 and sold thereafter. Acquire property after 22 February. You acquire property after 22 February 2019 and you sell it thereafter. Under the circumstances, CGT equals 20% of capital gain. 20% of capital gain. So this one is super important. Right? 20% of capital gain. And then withholding tax, capital gains withholding tax on marketable securities. Capital gain withholding tax. Withholding tax. Unaza chinonzi withholding tax. It takes inobatwa at the source. It takes inobatwa at the source. It takes inobatwa at the source. So on listed securities, securities which are traded on Zimbabwe Stock Exchange, that's listed. Then withholding tax, it's 1% of sales proceeds. It's 1% of sales proceeds and is a final tax. 1% of sales proceeds and is a final tax. Take note of that. That's not even my shares anotengeswa pa stock exchange. Ukatengesa mashares ako econet ari pa stock exchange. Unobatirwa 1% and 1% iyoyo ndo inenge yato capital gains tax. If final tax ausina chimwe chekubhadhara futi. Then unlisted securities, mashares ana Atlantic resources. Mashares ana Atlantic resources in company. We call these unlisted securities. Kanama unlisted securities, capital gain manch. You know, for unlisted securities, capital gain withholding tax. Withholding tax equals 5% of sales proceeds. 5% of sales proceeds. Saka ungati naise ichi chinonzi withholding tax. Commissioner haamirire kuti kana watengesa mashares umbotanga wapiwa mari yacho yese. Then wozoti after wambopiwa mari yacho yese wozoti zviya capital gains tax chi kazhinji hauzoiendesi. Saka zvinoitika maende zvoti commissioner anobata ka withholding tax. And ka withholding tax kanoseva just that. Kanobatwa kuitira kuti tisave nesituation yekuti tisave nesituation yekuti unopiwa mari wozotadza kuendesa capital gains tax. And unoziva kuti danger yekusaendesa capital gains tax ndeyekuti wawatengesera haawane title deed, wawatengesera haawane proof of ownership kana usati wapiwa capital gains tax clearance. Then on immovable property on let's say immovable property, let's say sales of immovable property acquired after sales of immovable property acquired after 22 February 2019. Ukatengesa immovable property acquired after 22 February 2009. Capital gains withholding tax 15% of sales proceeds. Right. Wapapata. Iwe Ernest imbonyatsoutsanangura nase tenda imbotaura nase
ndinotore mubvunzo
withholding tax capital gains. Yes, Ernest, I see.
I've got a question.
Yes.
Where you are saying capital gains tax is 20% of capital gain. That means if my property that I bought has not gained anything, I won't pay anything. Is that what it means?
If what?
If you can show your screen so that I can show you what I'm talking about.
Yes.
You have said if it's capital gains, it's 20% on capital gain.
Yes.
So I'm saying if I bought a property after 22 February and it hasn't gained any value, I've sold it at the same value, am I not supposed to pay anything?
Yes, you won't pay anything.
All right.
Yes.
I think that's clear.
Because there is no gain.
Thank you.
These are the rates of capital gains tax. Remember, my rates are one from anywhere. You're not one from your sale like this. Because any material is available for your reading. I know. So I want to go back up. So ndaverenga bepa ra 2019 sale ranga richiti 2009 tax dzochinja. Ona takutaura zvata 2019 kwete zvata 2009. Now, chinotisa something chili so special which I want to emphasize. Inzwa kune chinonzi withholding tax, capital gain withholding tax. Iyi haisiriyo capital gains tax, but itax inongofana kugara yabhadharwa pamunotengeserana kuitira kuti ukazocalculate capital gains unogona kuzowana, ukazocalculate capital gain tax unogona kuzowana tax refundable kana kuti payable. Zvangofanana nekubasa kwako unobatirwa payee kuitira kuti ukazocalculate tax unogona kuwana tax payable or refundable. Kana iri company inobatirwa ma-QPDs kuitira kuti patinozocalculate tax tinozoti less payable or refundable. Capital gains chinogara chabatwa kuitira kuti paunozocalculate with capital gain tax unozowana tax refundable or payable. Now, that's one thing. Kana asset yawatengesa yakaacquired before 22 February 2019, hapana need yekumbosocalculate capital gain. Chaunongoita iwe kungoti 5% ye-sales proceeds. Zvinganetse kuwi. Kana asset yawatengesa 2 February 2019, let me repeat. Capital gain kungoti capital gains tax mari inobviswa setax inongori 5% ye-selling price. Hatitombodi kuziva kuti cost yanga iri mari kana kuti chii. Number 2, ukatengesa ma-listed securities, whether ma-bonds a-listed company or what, capital gain inongori 1% of sales proceeds and i-final tax hapasina imwe yautatengesa. And izvo hazvinei nekuti yanga yakatengwa before 22 February kana kuti chii, as long as iri listed security inongori 1%. Asi kana ukazotengesa chinhu changa chiri acquired after 22 February 2019, apa manje pakunzi tax i-20% ye-capital gain, kurati padatanga pacalculate kwa capital gain. Computation of capital gain. Right. Computation of capital gain. What I'm yet to display how it is computed. Let me put a point to note, which is NB. Not necessary. The asset sold was acquired when the asset sold was acquired prior to February 2019. Yanga yakakwaiwa prior to 2019 ina basa since CGT is just 5% of sales proceeds. 5% of sales proceeds. Please get that right. It's just 5% of sales proceeds. So on this one, let me do this, and do this. So how do we compute capital gains? We start with marketable securities sold. Marketable, let's say sales of marketable securities, sales of marketable securities, acquired, sales of marketable securities acquired after 22 February 2019. Ukatengesa marketable securities acquired after 22. Ungati madebts anoshandira anochinjwa ma-statutory instruments. Ndosaka ari ma-special debts. Ma-statutory instruments anongochinja maakuzviziva imi, especially kana uri muZimbabwe. So unongoita unoti, oh, I said since CGT is just 5% of sales proceeds, this line, or 1% if we are talking of market listed securities, if listed securities. So here's the deal. You say sales proceeds. So you have to know what is it that, what were our sales proceeds? You put XXX. These are marketable securities. And then you say less exemptions. So there will be exemptions if any. Not like always. If there are exemptions, then it's fine. And then you say deductions. So let us have deductions here. Deductions, you go through them one by one. You first say cost of the asset, it's a deduction, cost of assets. The amount we paid to acquire these assets. And then you say add inflation allowance. Inflation allowance. Actually, inflation allowance is 2.5% per annum. 2.5% per annum. That's inflation allowance. Then you say broker's fees, brokers fees, slash commission. Remember, when you sell shares, the commission and whatever is charged to you needs also to be, it's an expense. Okay. All right, so what you then do is you put your total deductions here, and what you then have is capital gain. Capital gain, this becomes the capital gain. And then after you've calculated capital gains, you then say capital gains takes CGT at 20%. Remember, I told you that the capital gains tax is 20% when you dispose these particular securities. Right? So there you go. And then we proceed to sales of immovable property. Of immovable property acquired after 1 February 2019. Kana calculate capital gains tax kana property yawakatengesa yaka-acquired after 22 February 2019. It's again an easy thing to do if it was acquired after 22nd of February 2019. So what you do is you say sales proceeds, like this, and then you say less recoupment, if any. Make sure what we are talking here is immovable property. Ukatengesa tractor pana capital gains, not tractor clearly haisi immovable property. Saka ukanzi munhu akatengesa mabuildings, matractor, marori, chicalculate capital gains tax. Usabwaisa nematractor nemarori because those are not immovable property. Less recoupment. You now know my recoupment from our earlier chapters. Now, if you say sales proceeds less recoupment, what you get is called gross capital amount. What you get there is called gross capital amount. Then you say less exemptions, if any. And what you get is called capital amount. After you've taken, now if we are saying less recoupment, this recoupment or on immovable property, not any other, as not movables, immovable property, not on movables. Please take note of that. Then what you then get here is called capital amount. So this becomes capital amount. And then you say deductions. Now deductions are allowable deductions. And when you're calculating capital gains tax, when we are saying deductions, you say cost of the asset that we are talking about. Then you say less capital allowance is granted. Less capital allowance is granted. kana papa ine capital allowances akagrandwa paasset iyoyi unaabvisa panapa, because otherwise inoita double deduction. Kuti ku-income tax wakapiwa capital allowances kunoku wozoscot. Then unobva what inflation allowance. Inflation allowance, remember, it's 2.5% per annum on cost. Per annum on cost of the asset. So important, that inflation allowance is 2.5% per annum on cost. So if this is 7 years, you multiply by 7 years. And then other costs are like additions. Unozviziva kuti unogona kutenga imba isina jurawo woisa jurawo, so ikosti futi. Ukazotengesa imba hauti handisi kutengesa jurawo, unotengesa zvese. Then you say again inflation allowance on additions. On additions, if there are any additions, please make sure you add inflation allowance. And then agents fees. Agents fees or sales commission. Agents fees or sales commission. All right. You have it here. Agents fees or sales commission, and then you say etc. If there's any other thing there, you will notice out my capital allowances are my brackets. My capital allowances are my brackets. So what you then have to do is, these are your total deductions. And then what you then have to do is you calculate capital gains tax. This becomes capital gain. Capital gain. That's your capital gain here. And then CGT at 20%. You put your answer there. If it's no shanda chete ndokunge asset yatengeswa yanga yakatengwa after 1 February after 22 February 2019. If ngazvibatwe. Now notes. Now let us have notes to remember. Notes to remember. These are the important notes for you guys to remember. So I'm going to have them one by one. Say A. I say recoupment acted from sales proceeds. From sales proceeds. Because it is taxed under income tax. Under income tax. Remember, tine income tax, tine value added tax, tine capital gains tax. Saka iwo ukatengesa building rawatengesa rine recoupment iyo inotaxwa ku income tax. Saka ukasaibvisa mu sales proceeds inenge yakutotaxwa twice, under income tax yotaxwa futi under capital gains tax. Saka ukanzi chidefine a gross capital amount unongoti sales proceeds less recoupment. B, exemptions. There are anonymous exemptions capital gains tax. These are amounts which are exempt in terms of capital gains tax. As my exemptions are unoziya ku Income Tax Act. They include list my exemptions. Now these exemptions you can there are various ways you can get these exemptions. Let me show you. Exemption amounts which are exempt for capital gains tax. Exempt amounts for CGT Zimbabwe. You can look them up like this. You get all the amounts which are exempt for capital gains tax in Zim. And examiners can give you any of these amounts. Right. So why I open this is because I want to copy all this. I want to copy all this because all these are the amounts which are exempt. I can't be typing all these. They include, then I paste. Notice, all these amounts are exempt for capital gains tax. Oh, so let me extend the columns. Right. So all these amounts are exempt for capital gains tax. So let me go over them one by one. Transfer of any specified assets between spouses. So if spouses transfer assets to each other, they are exempt because the assets can be transferred at cost. And if you transfer something at cost, it means you did not gain anything. Transfer of principal private residence between former spouses in pursuit of a divorce order. So kana vanhu vakurambana vakatransfer imba yekugara kuti imba yekugara yakuenda kuna husband kana kuti kuna wife, hapana capital gains tax. Transfer or disposal of specified assets by a deceased estate. In other words, kana taakugova nhaka, pakugova nhaka poonekwa kunzi muzukuru achapiwa imba kana kuti land kana kuti stand, as long as iri immovable property kana kuti atapiwa marketable securities, mashares, anonzi specified assets, as long as zvichiitwa na-executor of the deceased estate, hapana capital gains tax. Then transfer of principal private residence by an individual. When they say transfer, even sale of principal private residence by an individual who is 55 years or older at the date of transfer. Saka zvinofadza sei ukatengesa imba wa 55 years or older, hapana capital gains tax, mari yese ndeyako. Saka zvinoreva kuti kana wanga wane 52 years uchida kutengesa imba, chingomira dzimwe 3 years ungosvika 55 uite chirungu. Ngomira dzimwe 3 years uzingoita chirungu. Tax yese yanga wachiendesa kuzimura yako. Disposal of principal private residence by an individual where all the sales proceeds are used to acquire or construct a new principal private residence, PPR. Zvikureva kuti ukatengesa imba yako yekugara woshandisa mari yacho yese kunotenga imwe imba yako yekugara, hapana capital gains tax. Ngazvibatike izvo because washandisa ese maproceeds, inonzi rollover provision. And then transfer of business properties, use of business property used for the purpose of trade by an individual to a company under his or her control and still to be used for business. Uka transfer property yako Time wanga uine imba yako kugweru, imba yako uishandisa sema offices. Apana capital gains because you are using it still for trade. Donations of housing units to a local authority or an employee share ownership scheme. Company can create a ownership scheme, cannot a trust yekuzoriwata my employees. You can transfer land, you can transfer my building, you can transfer what? Apana capital gains tax. Because all these amounts are exempt. I shall come to these, some of the issues could define how to teach on the PPR later. For now, let me proceed with my discussion on, allow me to proceed with my discussion on points to note. So B was on exemptions, then C, deemed sales. Now, chikakuti chii chinonzi deemed sales. I ask my sales per se, but by the interpretation of the law, tinoti my sales. These are not necessarily sales, but they become sales by the interpretation of the law. So what are such sales? Ekuti unogona kufungidzira kuti handina kutengesa, asi watotengesa, like donations of specified assets. Donations of specified assets. Ukadonata mashares, kana kudonata land, kana kudonata building, whether kuvana kana kuti kupi. Inotori sale panofana kutokalkulatwa capital gains tax. Asi nyaya yeupenzi yekuti the market value at the date of donation, the market value at the date of donation, the market value at the date of donation is deemed to be the selling price. The market value of these specified assets at the date of donation is deemed to be the selling price. Saka to calculate CGT, capital gains tax. That's 1. 2. Court order sales. Court order sales. Uneziya court order iya yekuti wakatora loan kubanki ndobva wapledge building rako kana kuti factory yako secollateral. Anonzi court order sales. Under the circumstances, the price at which the asset is sold the selling price. Imba yako ikatachwa ne high court, messenger of court, kuti yakutono auction, atizoshandise market value, but price yatongotengeswa imba yako iyo ndo selling price. 3. Damaged goods. Suppose you've got damaged property. Property yako ikadamaged, you say insurance compensation. The insurance compensation is deemed the selling price. Damage of property ukapiwa insurance compensation. Insurance ukapiwa hiyo is deemed to be the selling price. But there's a catchphrase there. If the entire insurance proceeds are used acquire another specified asset, specified asset in Zimbabwe, within 2 years, then the insurance proceeds will be exempt from CGT. The insurance proceeds will be exempt from CGT. Wapiwa insurance, wapiwa insurance, imba yako ya destroy ne storm. Wono acquire imwe imba kana kuvaka imwe imba within 2 years plus in Zimbabwe. Woshandisa mari yacho yese wakapiwa se compensation. Kwete wapiwa 200,000 wozongoshandisa 50 kutenga imba okuwadzana. Imwe 150 woisa pakanaka. Iya wazisewo pakanaka ine capital gains. Number 4, these are deemed sales, forced sales, e.g. as a result of road construction. Unogona kuforcwa negovernment kutengesa mabuildings because government inoda kupaisa road pane mabuilding ako. So what it means is the market value at the date of enforcement deemed to be selling price. Opabata ukaforcwa kutengesa mabuildings ako, market value yacho is selling price. So, right. Then deductions. I asked my deductions are Jaira Income Tax Act. So these are amounts allowable as deductions in terms of Capital Gains Tax Act. Mari dzinobvumidzwa sema deductions ku income tax zvawaitaura zvana pension zvanani aya maamounts atinobvumidza sema deductions ku Capital Gains Tax Act. Ukumaona ndiri kungoenda through zvandakupa panapa izvi kuti tinoweka sei. Ndakungoexplaina 1 by 1 in 10. Ndio zvandiri kungoita panapa. Ndatopedza kudhara topic. Kwangu ungoexplaina mapoints aya. They include so there you go. My deductions anosanganisira chi. So they include 1, cost of the specified asset. The cost here every asset, yes, specified asset. Not only immovable property, kana kuti marketable securities. Do anonzi specified assets. Saka ukapakatengeswa nechicombine harvester nechi kana kuti temporary shade inosanganisira additions, cost of additions to specified assets. Cost of additions to specified assets. Kana paine my additions to specified assets anopinda futi. Get that? Right? Chimwe chinoqualify sema deductions that cost of additions to specified assets. Imwe inflationary allowance. See. inflation allowance. Inflation allowance. Now, inflation allowance is at the cost of, is at 2.5% per annum on cost. Per annum on cost. Straight line. Including the year of disposal. Including the year of disposal. Do I not my inflation allowance? I no charge at 2.5% per year straight line, including the year of disposal. Saka iwewe ukatenga asset muna 2019 muna March terera. Watenga asset muna 2019 muna March woitengesa nhasi. Inflation allowance inenge iri 2.5% ye cost yemuna 2019, yemuna 2020, nemuna 2021. Inoto include a year of disposal, and it's a straight line aitwe time apportion. D. Deductions. Agency fees or transfer fees. Agency fees or transfer fees or commission. Nyaya dzekutengeserwa properties, unoenda kunana Don Properties, vanodawo commission yekuti they have sold something. They require that commission. And as such, you need to include that particular amount as cost. Then you say NB, still on this point, you say capital allowances are deducted because they are capital allowances are deducted, in other words, excluded. That's what we mean. They are deducted or excluded because they are granted for income tax purposes. For income tax purposes. Right? Right. So we are just wrapping it up. Then the other is suspensive sales. Suspensive sales. Now, what do we mean by suspensive sales? These are sales of movable property in which payment is to be done in installments. Payment is done in installments. We are selling immovable property, but in a manner that payment is to be done in installments. So what then do you do under the circumstances? What you do then is for gain, capital gain is first calculated as if payment is made in full. You first compute capital gain as if payment is made in full. Then, however, let's say then, comma, the gain attributable to installment debtors outstanding is deducted. The gain attributable to installment debtors outstanding is removed. We call this suspensive sale allowance. Suspensive sale allowance. You can't expect, listen, you can't say the customer of your property is paying you over 3 years and the commissioner requires capital gain in full. The commissioner requires tax in full. It doesn't work out that way. So what you then have to do, is capital gain. So you say capital gain as before, worked as if it happened. Yes, happened. So you calculate capital gain as if nothing has happened. You get your answer. Saying capital gain CGT at 20% like what we were doing. This time you don't do it like that. Instead of saying CGT at 20%, you then say less suspensive sale allowance. You know, suspensive sale allowance, we are acknowledging that some of the customers are yet to pay you. So all you have to do is you say gain, you say capital gain over sales proceeds times capital gain over sales proceeds times installment debtors outstanding. Yeah. Key thing is installment debtors outstanding at year end. Key thing is at year end. Not at the beginning, but the installment debtors which are outstanding at year end. That's how you calculate a suspensive sale allowance. So, after you've calculated suspensive sale allowance, you take it out here because you are acknowledging that there is capital gain on installment debtors which are outstanding. Then you have what is called a recognized capital gain. Recognized capital gain. Then you say CGT at 20%. CGT at 20%, you get the answer. As a general rule, you don't pay tax if some of the customers are yet to pay you. So you just use proportion to find what capital gain is included in customers who are yet to pay you. So that's the proportion. Capital gain over sales proceeds times installment debtors outstanding. Once you have done that, you can now take that out because they are yet to pay you. So the total capital gain, which is calculated as if everyone has paid you, is this. Then less is a capital gain included in installment debtors, and then you sort out the mess. Then continuing on NB, you say the suspensive sale allowance, for each year included in capital gain for the next year or the next year. The reason why we are taking out suspensive sale is we are saying some debtors are yet to pay you. So if they have paid you next year, make sure you include this for next year. Then rollover provisions. Rollover provisions. Rollover provisions. What are these? What do we mean when we are saying rollover provisions? We are simply saying these arise when the proceeds from sale of specified assets are used to acquire another specified asset. This arise when part or all of the proceeds sales of a specified asset are used to acquire another specified asset in Zimbabwe within 2 years. They are used to acquire another specified asset in Zimbabwe within 2 years. The key thing is if all are used to acquire another specified asset, if all the proceeds are used to acquire another specified asset, the proceeds are used to acquire another specified asset, then no capital gain tax arises. No capital gain tax arises. So if all the proceeds are used to acquire another specified asset, there is no capital gain tax. The key thing is all. If all the proceeds, like you sell the asset for 200,000 and you use the full 200,000 to buy another asset in Zimbabwe within 2 years, then if that is the case, no capital gain tax arises because you have used all the proceeds, right? Then another is if part of the proceeds are used to acquire, if part of the proceeds are used to acquire another specified asset, if part of the proceeds are used to acquire another specified asset, if you use part of the proceeds to acquire another specified asset, then the taxable capital gain is found by apportioning. Taxable capital gain found by proportion of an expended amount to total proceeds. So, for example, let me explain this part. for example, write textbooks. It's easy to write a textbook. You can see, if you read my notes, this is how I come up with my notes in the textbook. It will be like this. They just fall into line naturally. Sales proceeds. Let's say sales proceeds were 600,000. And then used for acquiring, used to acquire another PPE, used to acquire another specified asset. Now you used say 400 to acquire another specified asset. You use the 400,000 to acquire another specified asset. So what you do is procedure. Here's the procedure. The procedure is like this. Calculate full capital gain on 600 using calculate full capital gain on 600,000 sales proceeds. You work out capital gain on 600,000 sales proceeds. So you have to work it out and find it. So how you work it out is what we have illustrated already. You get that? You work it out as if no amount was spent on anything else. So you use this template to calculate the capital gain on 600. But after you have obtained capital gain, don't just rush to say capital gain is. Then you say less. Then you say, now after you've calculated capital gain, you say you close this figure. It's important to close this figure. Once you have closed this figure here, once you have closed this figure, you then say recognized gain. So the recognized gain, notice, you use the 400,000 to acquire another property. Recognized gain, meaning recognized gain for tax purposes. The recognized gain for tax purposes, it's attributable to an expended amount. The amount you didn't spend is the gain in that amount is that which is taxed. So you say 200,000 over 600,000 times capital gain. This is the gain which will then be taxed, capital gain. So you then put the gain here. So once you have found the gain, this is the gain which is then taxed. So you then say CGT at 20%. You then tax this gain. Get that? Simple as that. Okay. Then we mentioned on the go, we mentioned something which was called principal private residence. Principal private residence. It is shortened as PPR. PPR. Principal Private Residence, or PPR. What you need to know about this particular residence is, 1, it is the sole residence of the taxpayer. Sole residence of the taxpayer. It is the sole residence of the taxpayer. That's the first thing. Sole residence of the taxpayer. In use for at least 5 years. For at least 5 years. Aungati ndo imba yangu yekugara wangu waigara 1 year. No, it should have been in use for at least 5 years. And then it includes adjacent adjacent properties such as cottages, swimming pools. It is imba yekugara inogona kuinclude a cottage even wanga usingagari mucottage, but kana ukavaka imbawo ine cottage inoita part of the principal private residence. So key thing, these are the provisions, CGT provisions on PPR. CGT, capital gains tax provisions on PPR. Capital gains tax provisions on PPR. Knowing that there is something which is called principal private residence, what are the capital gains tax implications? 1, no capital gain tax arises by an elder that who is 55 years plus. 55 years plus. 55 years plus date of sale. The moment you are 55 years plus at the date of sale, there's no capital gain tax which arises. Next is couples can be taxed separately. Couples can let's say are taxed separately on sale of PPR. And if they are both 55 years and older, then no CGT arises. However, if one of them is below 55 years, then half of the gain is taxable. Mukatengesa imba umwe wacho aine 40 umwe aine 60. Ane 40 half yake inotaxwa because asati asita 55 years. But iye ane 40 anogona kuelecta kutransfer kuna ane 55 years portion yake hapana chinozotaxwa. ane 40 anogona kuti share yangu yeproperty rega ndiitransfer kuna ane 55 hapasina chinozotaxwa. For those younger than 55, for those younger than 55 years, for those which are younger than 55 years, comma, no CGT arises on sale of PPR if all the proceeds are used to acquire another PPR in Zim within years. If you use all the proceeds to acquire another PPR in Zim within 2 years, there's no capital gain which arises. If only part of the proceeds are used, if only part of the proceeds from the sale of PPR by those under 55, if only part of the proceeds are used on sale of PPR by those under 55 years, then the rollover provisions apply. Rollover provision discussed above applies. Saka kana uri below 55 years ukatengesa property, woshandisa part ye proceeds kutenga imwe property, capital gain unocalculate as if tasaone rollover provision. Rollover provision inoti tanga wacalculate capital gain as if nothing has happened. Calculate capital gain on the full proceeds, then wozoita a portion capital gain iri pa amount iri unexpended ndo capital gain inotaxwa. Saka unoita proportion. Saka ukaspenda 400 ukasara ne 200, proportion inenge yakuti 200 over 6 because iyi capital gain ndeye 600. Saka proportion inenge kuti 200 over 600 times this capital gain kuti uwane capital gain iri pamari yausina kuspenda. Iyoyo ndo inonzi recognized gain, ndo yaunotaxwa iyo. Oh, you guys are stars, and at least I've said quite a lot. Then transfer of property between companies under the same control. Transfer of property between transfer of specified assets between companies under the same control. Perhaps let me wrap up by that. Transfer of specified between companies under the same control. Now, if assets are transferred between companies under the same control, you can elect to transfer these assets at cost. The transferring company can elect to have assets transferred at cost, and therefore no capital gain arises. You can elect to have these assets transferred at cost. Once you elect to do that, no capital gains arises. Then let's say, however, if are eventually sold to third parties, comma, then capital gain is computed as if the company that last owned the asset has been at all times the owner from the original date of purchase. So those network transfer my assets between companies under the same control. Company could transfer inogona kuchuza kuti ima transfer at cost enda ka transfer at cost hapana capital gain. Asi chinozoitika maendeke kuti kana ma-assets aya akazotengeswa, tomboti ma-assets aya azotengeswa to third parties, meaning outside the group. Company yapedzisira kutengesa ma-assets yanga iri ye-last owner, ndiyo inoconsiderwa as if ndiyo yanga iri owner from the original date of purchase, meaning kana takucalculata vana inflation allowance vanani, tinoita kucalculata from the date, kwete yayakatenga kubva kune another company, but yakatengwa asset ina original company, na original owner. You get that? So why ndaita a snippet here capital gains? It's because ndakakutumira ima question papers. Ndikati chikati chiite ima questions, but ukatarisa ma question papers zvandataura panapa nezviri ma question papers, especially zvana 22 February 2019, hazvimo muma question papers. Ndozvokufanira kuchiapply when you are answering those questions. Washibata ingoapply zvandatsanangura in this particular capital gains tax video. Ndichakugadzirai ma practice questions atichaita. For today ndakugadzirai ma notes. Ndotodafanira kuedita ma questions kuti ndite come up with questions because these are new provisions on capital gains. Atina these provisions in previous questions. So on that note, leave it up to me. Just stream yese ma topics. Kuroti une tax administration neirori anofanira kustreama. Please look them up on my YouTube channel. Please. Even lecture kasa stream rinenge riripo ku WhatsApp chat. Usamirire lecture kuti litumirwe link uzoti ndariona. Ukacheka ku WhatsApp chat kunoku. Aya ma lectures esatakaita last week. Ayarapa. Saka kana ukamirira kuti uchada ngoona lecture rako ku YouTube chete kuti uzoti la stream. Ayari tu aya. Tax administration ndiro iri ndo question practice yatakaita iyi. Saka ma lectures anenge aritopo kudhara. Saka usati andina ma lectures kana uri mu WhatsApp group iri. Deliver to your inbox. Anongoiswa mu chat. Unongoita the play button and you are already playing what we discussed last week. So you have those. So I'm now ending the recording. I will edit question papers to Bataita. So to the extent of that, enjoy the rest of your week, guys. Bye.